All right. Thank you all for joining us this evening. My name is Cindy Pankella, and thrilled to have you with us. Just want to give you a little housekeeping before we move on. You are all currently muted, and you will remain that way throughout the presentation. We do ask that if you have any questions at any time, to type them into the Q&A box that you'll see on your screen. And at the end of the webinar, that is when we will go to those Q&As and we will answer them. So no need to raise your hand, because all I'm going to do is tell you to type it into the Q&A. And if you have any technical difficulties or something, you can put that into the chat box, and I'll be more than happy to see if I can help you with that. It looks like people are still trying to get in, but I think we are going to get started. So our topic this evening is the CARES Act and the Paycheck Protection Program, or what you're hearing in the news is PPP, and the key considerations for the physicians and their practices. Our speaker today is attorney Jayme Matchinski, and she is an officer at the law firm of Greenfelder, Hemker, and Gale, PC, and works out of their Chicago office. She attended Valparaiso University Law School and now serves as chair of the National Advisory Council for the law school. She is the former vice president of a national healthcare consulting firm. She has successfully represented healthcare providers in reimbursement claims against insurance carriers and the Centers for Medicare and Medicaid Services, and has been practicing law for over 25 years. Jayme draws on her extensive experience in health and corporate law to help healthcare companies handle the complex regulatory and operational issues unique to the industry. She assists with compliance, reimbursement, licensure, and certification issues affecting healthcare providers, as well as the purchase, sale, and formation of healthcare entities. We're thrilled to have her here with us again, and I will now turn it over to her. Jayme?
Thank you. Thank you, Cindy, and thank you for that very generous intro. I'm very glad to be with all of you this evening, and I hope all of you are doing well and staying safe. When Cindy asked me to speak on this topic, I was very excited to speak because this has been in the news a lot lately. It's impacted everyone regarding financing and payroll, and it's trying to break this down to what does this mean for physicians and their practice. So what I'd like to do is I have some prepared slides. As Cindy mentioned, if you have any questions, please feel free to send them in, and we'll have some time at the end. So let's get started. I want to give you an overview of the key considerations for the PPP program under the CARES Act. So basically, let's see here. The objectives tonight for the presentation is to provide you an overview and provide an overview and give you the information about the CARES Act. The CARES Act was implemented on March 27th by President Trump, and it stands for the Coronavirus Aid, Relief, and Economic Security Act. So it's an acronym, and basically it implements the Paycheck Protection Program Act, the PPP, that I'll be referring to. So the CARES Act, and what's important to note is that this really implemented, and starting last Monday too on the 27th, I'm just going to give a brief history because I know all of you have been following this in the news, but this is in the moment as we go. I'm sure a lot of you have been following this. I've been getting a lot of updates on this as well from the legal standpoint. So the CARES Act, it implements the Paycheck Protection Program, and it's historically the SBA has had the ability to loan money, the Small Business Administration. So if you think about the CARES Act, there is an additional $310 billion that was implemented and instituted on Monday, the 27th. But the CARES Act, when it came out March 27th, it really was the third piece of federal legislation regarding the COVID-19, the pandemic. So we've had a lot of new regulations and not a lot of new guidelines, and the CARES Act has been up there, and it's really, it's impacted over $2 trillion, with a T, trillion dollars of economic relief bill for physicians and physician practices. So I want to give you an overview of the CARES Act. I want to talk about the impact of this economic relief for physicians and your practices. And then I have a checklist for reports and documentations that are required for the application process, and I want to talk about that. I've gotten a lot of questions recently from my clients asking me, is it too late? I don't believe it's too late to apply. A lot of this is in transition right now. I think you should stay tuned and make sure you're following what's going on. I don't have anything in writing yet, but I've been reading that there may be a third wave, a third round of additional money. So stay tuned and be alert. What's interesting is I've been trying to figure out, there's 4 lenders, and we'll talk about this in a minute, but there's 4 different lenders that are types of lenders that are able to lend under the PPP. The existing SBA approved lenders, federally insured depository institutions, federally insured credit unions, and then farm credit system institutions. And then there is some legal language in the CARES Act that says any other institution. And so we don't have guidance on what that means, but those are the 4 main PPP lenders at this point. What's interesting too is and we'll talk further about, there's a relaxation on some of the historic SBA lending rules. So we'll have a checklist towards the end of the presentation, and then I want to identify key considerations for you as physicians and your practices, and steps to take to prepare for the current round, the next round. So what was interesting is we've all heard in the news the publicly traded companies. There's been a lot of press on certain companies like Shake Shack, the LA Lakers, Ruth Chris Steakhouse. So a lot of these are publicly traded, and we'll look at the eligibility and the guidelines for borrowers under the PPP, and explain how some of this money was allocated. Some of those entities have decided to give the loan back, but there's been a lot of press about this. So stay tuned. There's no guarantee, but I have a feeling that there'll be a next round. And then with your bank and your lender, communication is really important. What's interesting is I read the other day that, for instance, JP Morgan has processed recently 8,500 loans for large businesses, and with 6%, just 6% of those loans being to 300,000 to small businesses. So it's interesting. I've had clients tell me, physician practices tell me that they've had good luck with their community bank. I've had other clients tell me that they've been with their big bank and had a good relationship. So unfortunately, I can't tell you hard and fast rules, because I think it's been all over the board as far as lenders and experiences. So if anything tonight, I hope some of your takeaway will be the information I provide and the checklist and the considerations, but persistence too. And I think if you're in the process of doing this, or have applied, or in the process, as you know and will know, documentation is going to be the key. I've received a lot of questions recently and requests from clients for their corporate documentation, for copies of their lease agreements, copies of their employment agreements, everything to document the financial aspect of their practice and their payment. And then, as I mentioned, lastly, identifying key considerations for the physicians and practices. So let's go forward. So as I've mentioned, the CARES Act, it really modifies, and just want to briefly go through this structure because I think it helps to explain, and we'll talk about some of the formulas on how these loan amounts are determined. So the CARES Act, it modifies Section 7A of the Small Business Act. So if you want to fully understand this, you have to also understand that Section 7A of the SBA has really been historically how small businesses have received funds. And you can go on the SBA's website, there's a lot of information, and the U.S. Department of Treasury, both those websites have a lot of information about the PPP. So this new Paycheck Protection Loan is under 7A, Section 7A 36, and it's available from the covered period from February 15th, and that's a very important date. So you have to be in business as of February 15th of this year, and the payment loan is from February 15th, 2020 to June 30th, 2020. So remember those dates, because when we look at the formulas in a minute, that's important. So the loans are available from the SBA and the Treasury approved banks and credit unions. So they're guaranteed by the SBA 100%, and that's changed. In the past, SBA loans were guaranteed 75%. So the CARES Act has increased the loan ratio to 100% until December 31st of this year. And then it'll be guaranteed at 85% for the loans less than $150,000, and then the scale 75% for loans over 150 after that date. So you don't need, what's important here is some of the traditional restrictions, if you will, or loan guidelines for underwriting don't apply under the CARES Act and the PPP. So you don't have to establish that you were unable to get credit elsewhere, and there's no personal guarantee is required and no collateral. And there's also no prepayment penalties, no guaranteed fees, and no yearly fees. So these have all been loosened to the extent of what a traditional SBA loan is. So what's important if you're applying or have applied, you have to certify the following in order to be eligible for a paycheck protection loan. You have to certify that given the uncertainty of the current economic conditions based on COVID-19, that this makes the loan necessary to support your practice, to support the ongoing operations of your practice. The funds will be used, and this is the key, the funds that you receive under the PPP and the CARES Act will be used to retain workers and maintain payroll or make mortgage payments. And we'll get back to the mortgage and the rent payment in a minute, and lease payments and utility. So it's really centered on these areas, payroll, mortgage payments, lease payments, and utility. And we're going to talk about loan forgiveness in a few minutes. Some of these funds are forgiven. So, and you also have to show as a borrower, you do not have to have an application for a loan under a Section 7A for the same purpose. So in the past you had to show that. You don't have to show that under this, under the PPP. And you have not, and you don't have to, and you should, and you have not received another 7A loan for the same purpose for this period. So this is a specific time period, February 15th, 2020, December 31st, 2020. So remember those dates, and you have to be in business and operation as of February 15th of this year to qualify. So just briefly want to go through, under the CARES Act, there's been this definition, it's expanded. It's expanded the definition of what a small business concern eligibility for these loans. So under Section 7A of the SBA, to include any business concerns, and there's a whole section on nonprofit organizations, the 501c3s, the 501c19s, veteran organizations, there's tribal, Indian health, there's carve-outs to small business concerns. And here's why the press about some of the bigger companies that I've mentioned, some of the restaurants and hotels and sports organizations. So it has to be no more or greater than 500 employees, or applicable the size industry for the size standard for the industry established by the SBA. So there's a whole discussion in regulation under the CARES Act for hotels and restaurants. And so if there's a parent entity, a parent company, and then separately owned corporations or entities under the parent company with separate tax IDs that have fewer than 500, that's how some of these loans have been processed. So getting back though to the small business concerns, it's important to take a look and see if it's a sole proprietor, independent contractors, or eligible self-employed individuals. So all of you know your practice and its structure. If you're an owner, a shareholder, a member of your practice, of your medical practice, if you're a partner, shareholder, as I mentioned. So we're going to talk in a few minutes about who's an authorized representative of the applicant. In the past with the SBA, you had to have all signatures for all owners of at least 20%. With the CARES Act and the PPP, you just have to have one person sign off. And there's been a lot of discussion from a legal standpoint as far as who's authorized to sign off on that. Does it have to be the president of the medical practice? Can it be one of the officers? So as long as you are an authorized representative of the applicant, and the lender, meaning the bank or the lender that you're going through to process your application, does not have to independently verify that. You will sign as an applicant that you're authorized representative of your entity, of your either a corporation or your LLC, your limited liability company, however you're organized from a corporate standpoint, you can have one person sign off. And then any business with less than 500 employees per physical location that has what's called an NAICS, and that's the North American Industry Classification System. So there's a series of codes of 72, and that, as I mentioned, the accommodation and food services. So that's where we've seen a lot of the publicly traded corporations using that classification. So under the Paycheck Protection loans on the guidance, again, just giving an overview, a top-level overview, the affiliation rules for measuring the number of employees are found in the Code of Federal Regulations at 13 CFR Section 121 and 103. And bottom line, the affiliation rules are waived for certain franchisors and those in accommodation and food. So again, depending on how they're structured corporately and with different tax ID numbers. So the definition of an employee, and this is important under the application process and under the CARES Act, you have to take the average number of days for each of the pay periods for the preceding 12 months. So if you haven't been in business for 12 months, say you just opened your practice in December of last year, so you haven't been in business for a full year, full 12 months, you take the average number of each pay period you've been in business. So you would go from December to the current time period to figure out what the pay period is. The SBA counts all individuals employed on a full-time basis, a part-time basis, or other basis. This includes employees that have been obtained from a temporary employee agency. So if you have any temporary employees, a PEO, which is a professional employer organization. And the PEO is basically, if any of you have involvement with the PEO, they usually do the HR, the human resource function for small and mid-sized businesses. So if you have any employees through a PEO or leasing concern. So it's really important to take an inventory of who you will have employed in your practice, whether they're full-time, part-time, or on another basis. And you have to really do a head count. So your paycheck protection loans, and this gets into some math, and this is the formula under the CARES Act and the PPP. So the maximum loan amount is the lesser of, you take the sum, and it's the lesser of the average monthly payroll cost for the first year prior to the date on which the loan is made. So 2.5 plus, the 2.5 plus any outstanding disaster loan that is under Section 7B. We'll talk about the disaster loan in a minute. Of the SBA that was made after January 31st, 2020 and refinanced into a 7A loan under the SBA or under the PPP, the current PPP. And then it's up to $10 million. So that's the basic formula that's in the legislation, in the regulation. And if you weren't in business from February 15th to 2019 through June 30th, 2019, you take the 2.5 multiplier and you multiply that by the average payroll cost from January 1, 2020, ending February 29th, 2020. So again, this is all formulaic, but very important, making sure that you have all your FTEs accounted for and you look back on your payroll cost and what your payroll was, because in a minute we'll talk about the forgiveness of the payroll. So if you have any seasonal employers, if you're a seasonal employer, meaning that you have certain people coming in and out of your practice at different time periods of the year, you take the 12-week period beginning February 15th upon election, and then you run that through the March 1st, 2019, ending June 30th, 2019. And then you look at this and you have the loan up to 250% of your average payroll cost. So the message here is make sure you have an accurate and complete head count of your FTEs throughout the previous time period so that you have credit for those and then that will go to your loan forgiveness. So the payroll costs, what is under the PPP? What's important to note is that the payment, it's really the payment of compensation, to employees for wages, commissions, salaries. And there is a cap not to exceed an annual rate of pay of $100,000. And where this becomes significant and important in your practice, if you have, depending on how you're paying yourself as the owner of your medical practice or your partners, the $100,000 is the cap if you're an employee of your practice. However, that does not include, it's capped based on compensation, but not on defined benefit plans or any type of 401k or any type of retirement planning. So any benefits, it's based on wages and commissioner salary paid out to the employee of the practice, capped at $100,000, but does not include the defined benefit or any deferred payment based on benefit program. So that's important. For self-employed taxpayers, as I mentioned, the net earnings from self-employment can be up to $100,000 with the exception of the defined benefit plans and healthcare and other benefits. Cash tips or equivalents, vacations, parental leave, family medical leave, sick leave. So these are all things not to exceed. Severance, separation, retirement benefits, group healthcare benefits, I mentioned, premiums, and then state or local taxes on compensation. So this becomes, again, you have to revisit how the payroll is being conducted and what's being paid out. So what's not counted, as I mentioned, is compensation above $100,000 for any one employee on an annualized basis, payroll taxes, and compensation for an employee whose principal place of residence is outside the U.S. what's been interesting in the CARES Act is there's carve-outs, if you will, there's exceptions for offshore companies, meaning they're not located and operating in the United States, they're not eligible, as well as any employees who have the principal place of residence outside of the US. And then also what's not counted under the PPP is any qualified sick leave and a family emergency leave, because that's covered under the Family Medical Leave Act under separate regulation. So very important to kind of make sure that you're not counting what's not eligible. So let me give you an example. Here's an example from the CARES Act. So we have a physician practice, as an example, had $2.4 million of total payroll costs for the period April 1st, 2019 through March 31st, 2020. The physician practice average monthly payroll costs were $200,000. So that physician practice, based on those numbers and that time period, the look back, I call it the look back period, is eligible for a paycheck protection loan equal to or lesser of $500,000 or up to the 10 million. So depending on all the factors. So that's, as you look at the payroll, based on this $200,000, it's the lesser of. Okay. What's the acceptable use of the funds? This is, I think, really at the heart, and this is what's caused a lot of the press, if you will, and a lot of the discussion about the loopholes, if you will, in the press about some of the publicly traded companies that have come under fire in recent weeks for taking these loans. So during the periods, what you can do if you get a PPP loan is you can use the funds during the period. Again, the magic date, if you will, is February 15th, 2020 through June 30th, 2020. And this hasn't been written into the regulations, but as I mentioned at the front of the top of the presentation, I think there'll be another round of, hopefully there'll be another round of loans and money allocated for this. We don't know that yet, but there's been a lot of discussion about that. And this June 30th date, because we don't know with COVID-19, with the shelter in place, the stay at home, and I know all of you are from around the country, so each state has its own set of stay orders and shelter in place and quarantine, whatever the verbiage is, by the governors and the mayors, if you will. So this June 30th date, I think, may move, but right now that's under the CARES Act as the date, the window. So as a borrower, you may use the funds that you get under the PPP for payroll costs, group health care benefits, any interest on any mortgage obligation. And this is important. Some people have thought that it's also can be used for mortgage payments. It's the interest on. And because all of these, in a minute, you'll see where it factors into loan forgiveness. So it's the interest on any mortgage obligation, not the actual mortgage payment. However, it does cover all of the rent, the utilities, and any interest or any other debt incurred before February 15th, 2020. So those are the acceptable uses of funds. So the term of the loan under the PPP, under the CARES Act, the maximum maturity is 10 years. And traditionally, SBA loans can go up to 30 years. So it's 10 years. The maximum interest rate of 4%, that's the maximum interest rate. It's usually 1% to 2.75%. And so the interest rate, and then the guaranteed deferral of repayment is 6 to 12 months. So that's a greater time period than historically has been allotted under SBA loans. So remember the payroll, group health benefits, interest on mortgage obligation, rent, utilities, and interest, because we're going to take a look at the forgiveness. So here's where the CARES Act and the PPP, I think the heart of it is going to offer relief to physicians and physician practices. So, and any other entity or business that is able to get a loan under the Paycheck Protection Program. So if you do get a loan and you use it for its intended purposes, the first 8 weeks worth of the certain payment will be forgiven on a tax-free basis. And again, it's the first 8 weeks worth of certain payments. So what payments are covered during the first 8 weeks? So we took a look at this, the interest, and not the mortgage payment itself, but the interest on a mortgage incurred before February 15th, 2020, rent for a lease that was in force before February 15th, 2020, certain utilities for any services started before February 15th, 2020, and then payroll costs. And that's the same definition as under Section 7A36. So that's the heart, if you will, of the importance of the PPP for receiving those funds. So the limit cannot exceed the principal of the note. And what that means is the interest will still be owed, but the limit cannot exceed the principal of the note. So the forgiveness amount has to be will be reduced if you, and this is important, the forgiveness amount will be reduced if you cut employees during that 8-week period. So if you allocate, you count all your FTEs and you have everybody on your payroll, and then you cut the employees during that 8-week period, that will reduce the forgiveness amount that you would be forgiven under the PPP. Or if you cut a salary of some of the employees during the 8-week period, or if you receive the advancement, a $10,000 advancement under the disaster loan program. And we'll talk a minute about that. That's the 7B under the SBA loan. So here's an example. If your practice had $2.4 million of total payroll costs, we go back to the example earlier, for the period April 1, 2019 through March 31st, 2020, and you had an average payroll of $200,000, you would be eligible, as we mentioned, equal to the lesser of the 500,000 or the 10 million. However, for instance, during the first 8, so we've looked at that formula, and that would be how it would be calculated under the PPP. During the first 8 weeks after your practice borrows the $500,000, it incurs payroll costs, mortgage interest, and utilities of $440,000. The $440,000 is eligible for forgiveness. And then the remaining $60,000 loan is deferred for at least 6 months and up to a year. So if you see the mechanism of how that works, so you get the loan under this example, just an example, but to follow the formula, you get the loan of $500,000 for your practice. Your payroll, mortgage interest, again, mortgage interest, not mortgage, but the interest on the mortgage, utilities is $440,000 for those 8 weeks. Then you are eligible for the forgiveness of the $440,000. So you would be, the remaining payment back on the loan would be $60,000, and that would be deferred for up to 6 months or up to a year, or at least 6 months up to a year. So that's the mechanism, and that's how the forgiveness, that's an example of how the forgiveness works. But again, remember, if you cut employees or reduce salary, we'll see in a second how that will impact that bottom line number. So the amount eligible for forgiveness is reduced by multiplying the forgiveness amount, as I mentioned. So what you have to take a look at is the quotient. If you look at the quotient obtained by dividing the average number of the FTEs of the borrower during the 8-week period from the date. So if you have the average number of full-time employees per month from February 15th, 2019 through June 30th, 2019, or the average number of FTEs per month from January 1, 2020 through February 29, 2020. So you can see this is very fact specific, and you have to make sure that you have very good records and documentation on all of these numbers, because it will play into not only your application, your approval of your application, but also the loan forgiveness period too, during that 8-week period. So I just want to give an example. The FTEs are determined by calculating, as I mentioned, under the CARES Act, the average number of FTE equivalents for each pay period within the month. Seasonal employees, which may or may not impact, your practice, from the February 15th to the 19th to the June 30th, 2019. So here's the example. If you had 30 FTEs in your practice during that 8-week period, after you borrowed the $500,000, and then if it was adjusted during the period in the previous year from February 15th, June 30th, 2019, and had 50, just as it did from January 1, 2020 through February 29, 2020, the loan forgiveness is the 440. So it would be reduced by 20, 50, or 40%. So again, a lot of this is formulaic in numbers, but these examples, I hope, demonstrate and illustrate the importance of having all the documentation in the records so that you can make sure your application is correct and that you have all of your, your payroll accounted for and your FTEs. Here's just another example too, and about the eligibility for forgiveness. It's also reduced by the total reduction in salary. So if you reduce one of your employees' salaries, under my example, I have an RN as an employee of a physician practice earns an annual salary of $70,000 as of March 2020. After the physician practice takes out the loan, the RN salary is reduced to $40,000, from $70,000 to $40,000. This was the greater than 25% decrease in the RN's wages. So therefore, the forgiveness amount of the $440,000 is reduced by another $30,000. So then the total forgiveness is the $440,000 amount minus the $176,000 minus the $30,000 or the $234,000. So a lot of this, again, is formulaic and math driven, but very important if you're doing any reduction in staff or salary, how that will impact your loan and the forgiveness. Just examples to illustrate that. So if there's a restoration, however, if there's a restoration of forgiveness, so if an employer replaces any full-time employer, restores any substantially reduced wages that occurred during that period from February 15, 2020 until 30 days after passage of the CARES Act, which was March 27, 2020, when compared to if you compare that to that February 15, 2020 date, the full forgiveness is again allowed. So there is a restoration of forgiveness within that 30-day window. So an example of that is, say on February 15, 2020 of this year, your practice had 40 employees before they were eventually cut down to 30 in April. On that February 15th date of this year, the physician practice paid the RN a salary of $60,000 that was reduced to $30,000 on April 1st. However, before June 30th, 2020, the physician practice rehires the 10 employees and raises the RN's salary back up to the $60,000. Then the practice is entitled to the full $440,000 of forgiveness again. So this is the restoration. So there's a forgiveness period under the CARES Act, and then there's a restoration of forgiveness. So the application for forgiveness, if the decisions are supposed to be made by the lenders within 60 days. And then as a borrower, you have to apply for the forgiveness, and the application must include. So here's some dates. This is the schedule of dates from the CARES Act. You have to show documentation, verification. This is after you've gone through the whole process with the application. You've applied, you've been accepted, you've been given a loan. You have to then document verifying the number of FTEs on the payroll and the pay rates for that period. And again, it's that window of time, that 8-week window for the covered period when the loan was taken out. And then the February 15th, 2019 to the June 30th, 2019, the dates we looked at previously, the January 1, 2020, February 29th, 2020. And then if you have any seasonal employees or employees that haven't been with you the whole time, the whole year. And then the February 15th, 2020 through 30 days after the enactment of the CARES Act. So these again are just important dates that apply to the application for forgiveness. Okay. So this can be done with payroll tax filings. There's been a lot of discussion in the CARES Act and the comments to the CARES Act about verifying payroll tax filings. Again, the lenders are not on the hook, if you will, for verifying data based on the sheer volume. So a lot of the underwriting policies and procedures that traditionally go with traditional SBA loans and other loans have been relaxed and waived. It really, as I mentioned, as the authorized representative of the applicant, you're verifying and certifying that your payroll tax filings and everything is accurate on the FTEs and the salaries. So the unemployment insurance, the documentation including canceled checks, verified payment on mortgages, rents, utilities, can all be done through this documentation. And then you're certifying, there's a certification that the information is true and correct, and that the amount of forgiveness requested was used to retain employees. So very important. It is a legal document to the extent that you on behalf of your practice and you're signing as an authorized representative, and you're certifying that the information is true and correct. So I just want to briefly go through other loan options. I've focused this evening on the 7A because that's been the attention that we've all been focused on the PPP under the CARES Act. However, there is in our disaster loan funds under 7B2 of the SBA. These loans are different than the PPP because they can be up to $2 million made directly from the SBA to meet working capital needs or normal business expenses when there's been a qualified disaster, which includes, of course, the COVID-19. And so this is for covered period. These are different dates than the 7A, the PPP. So the 7B2 is January 31st, 2020 through the end of this year, December 31st, 2020. The term is 30 years. The rate is 3.75% interest for a for-profit business and 2.75% for a not-for-profit. There's, again, no personal guarantee similar to the PPP is needed for this. However, this is up to $200,000, so no personal guarantee for up to $200,000. It's available to businesses, tribal concerns with less than 500 employees, a solo proprietorship, or with or without employees, or an independent contractor. And then also an ESOP. There's been a lot of discussion about lenders. ESOP, of course, is the employee stock ownership plan under Section 501c3 or a Section 501c3. And then this disaster loan no longer requires the business to be in business, the practice to be in business for a year before the disaster. So there are options in addition to the PPP, this disaster loan under the 7B. These loans are made after January 31st, 2020 also for payroll purposes, and before the date, the Paycheck Protection loans are ready to go, and they may be refinanced. You can roll this. Eventually, you may be able to roll this and should be able to roll this into refinance into a Paycheck Protection loan. So the CARES Act provides that you can still take a disaster loan between January 31st, 2020, and then to the date of the PPP loan will be available. So as long as the loan, and this is the key, because some of my clients, some of my medical practice have talked about getting both the 7A and the 7B, the PPP and the disaster loan, as long as the loan is for the purpose the disaster loan other than paying payroll, you can still get a Paycheck Protection loan. So think about the PPP for the payroll and the mortgage interest, the utilities, the rent, things that we looked at previously. And then this disaster loan is for other purposes. There's emergency grant from January 31st, 2020 through the end of this year, December 31st. Under 7B, you can request up to a $10,000 advance. It can be used to pay sick leave, maintain payroll, meet increased costs of materials, make rent or mortgage payments, or repay obligations. So this $10,000 is not required to be repaid under the disaster loan, the 7B, even if the disaster loan is denied. So there's $10,000 of money, even if the loan is eventually denied. And if the application for the loan, the disaster loan, then is transferred, if you will, converted into a Paycheck Protection loan, that $10,000 advance amount is reduced from the loan forgiveness that we previously discussed. So again, this is an option, a viable option, taking a look at what your needs are. This is one other loan option. And then the funds are to be advanced within 3 days of an application. So that's the disaster emergency grant under 7B. So just briefly, the traditional 7A loans, you can still apply. You can still apply for the traditional 7A loans under the SBA. The maximum loan is up to $5 million. The terms are different. It's a 10-year term without real estate purchase. It can go up to 25 years with real estate. And then the rates are the interest rate 1 to 2.75% rate. As I mentioned previously, it's 75 to 85% guaranteed by the SBA. The PPPs are 100% guaranteed under the CARES Act. And then this is under the traditional 7A SBA loan. It's a subsidized payment. The SBA will pay 6 months of principal, interest, and fees on a 7A loan other than a Paycheck Protection loan. So my point here is in addition to the PPP, there's other options that you can use in addition to the PPP. So how do these loans interact? Just briefly, the borrower can apply for the PPP loan and other SBA financial assistance, as I mentioned, including a disaster loan and a 7A loan. However, you cannot use a PPP loan for the same purpose as your other SBA loans. So you have to be very careful how you coordinate this. So for example, if you use your PPP loan to cover payroll for your practice for an 8-week covered period, you cannot use a different SBA loan for the payroll for those same costs in that period. Although you could use it for payroll not during that period or for different workers. So this can become very complicated. And so really important to focus on, what your needs are and what's the best loan, and what's the option. Just briefly, the disaster loans and the $10,000 under the disaster loans, it grants you up to the 7A loans receiving a 6-month subsidy. And that $10,000 grant reduces the forgiveness amount. So when would you choose a disaster loan? If you and your practice had significant non-payroll costs. So that might be a viable option. And then if it was for payments that wouldn't be forgivable, or if you weren't able to get forgiveness because you laid people off or cut salaries because the disaster loan had more favorable terms, a 30-year period. So again, you have to really take a look and make sure you have the right loan or loans, combination of loans. So I just want to run through, I wanted to give you a checklist because I know that this is a lot of decisions to make and it can become complicated, and especially we're all evolving in this very difficult time in trying to figure this out. So I think checklists help, and so here's what you'll need for reports and documents that are required, for application to the Paycheck Protection Program. So I'm talking about the 7A SBA loan for the PPP. As I mentioned earlier, making sure you have all your corporate documents, your payroll taxes, payroll salaries, and all your benefits, knowing what you're paying out for your FTEs, your leases, your mortgage payments, all the financial threshold documents that you'll need to know and have to fill out the application. So you're going to have to confirm that the applicant, the physician practice, and any of its owners are not presently involved in any bankruptcy proceedings. You're going to have to also confirm in connection with any government contracting activities that you're not suspended. Specifically, I think of Medicare, Medicaid, any government payment program, TRICARE, Champus that you may have, or your practice may have a provider number, or any of your owners of your practice or your owners, meaning the other physicians, are not presently suspended, debarred, or proposed for debarment or declared ineligible. So making sure you're in good standing with all the federal programs, including Medicare, Medicaid, and the other programs. You have to confirm that the related business, your practice, or any of its owners are not excluded from the PPP by a federal agency, by another federal agency. You have to confirm as a checklist that your related business, your practice, or its owners have never taken a loan that it's defaulted under the SBA for the previous 7 years, for the last 7 years, or caused a loss to the government. So that's one requirement as far as the underwriting, that you're not in current delinquency under a SBA loan or other agencies. That your practice or any 20% owner is not subject to criminal charges, incarcerated, on probation or on parole. Interestingly enough, in the regulations, this is a 5-year look-back period. Now, granted, many of you know this as far as your medical license. You can have a felony conviction under the PPP, but it has to be more than 5 years ago. So that's the window they're looking at. And then confirmation that the related business or 20% owners within the last 7 years have not otherwise been punished for a felony or misdemeanor crime against a minor. That's against a minor. Okay, also in addition to the checklist, I would encourage you to consider too your current economic viability and uncertainty. You have to verify that it makes the loan necessary to support your ongoing operations, and the funds will be used to retain workers and maintain payroll, and that you have not and will not receive another loan under the PPP, specifically under the PPP 7A under the CARES Act. And the applicant will provide the lender with documentation to verify all FTEs, payroll, dollar amounts, covered rent payments, mortgage interest payments, as we mentioned, all of the documentation, covered utilities. So due to the high subscription in this program, the PPP, it's anticipated that not more than 25% of the forgiven amount may be for non-payroll costs. So that's a helpful number to keep in mind. And that all information that you're supplying and providing is true and accurate. And there's a statement, if you knowingly make a false statement, and you have to attest that to obtain the loan, punishable by law. So you have to verify and certify and attest that you're providing true and accurate information. And then the applicant acknowledges that the lender will calculate the eligible loan using the tax documents submitted. Again, this isn't going to be independently verified by the lender, but by the applicant. And the applicant understands and acknowledges that the lender can share the tax information with the SBA's authorized representative for the purposes of processing the loan. There's a big discussion about the SBA being able to sell these loan applications to another party, and that's been acceptable. There's been language in the CARES Act that said that can happen, take place. Okay, I just want to end. I know this is a lot of information, technical information on numbers and formulas. I think as you're looking at this, some of your key considerations for you as physicians and your practices during this pandemic in light of the CARES Act and the PPP. As I've been talking to many physicians during the last few weeks, the key has been centered on, of course, patient care and wanting to get back and provide care to patients and the documentation of that care. There's been and Cindy's going to talk about this in a minute, there's been a great increase in telemedicine. And the AOA is providing a lot of good programs on telemedicine and how to implement that and establish that in your practice. And then the reimbursement, as we've talked this evening, and the payment from third-party payers for the care that you provided to your patients. Scope of practice and licensure. What's been really interesting in the last few weeks is here in Illinois, like most states, the state licensing body here in Illinois, it's the Illinois Department of Financial Professional Regulation, IDFPR, has loosened some of the waive-ins, if you will, of out-of-state practitioners to help with the pandemic and the care of patients. So scope of practice and licensure, regulatory compliance. There's been a whole discussion about Stark waiver, the 1135. So in addition to the PPP and the CARES Act, there's also been a lot of other regulatory movement and evolution on those regulations. And then financial considerations. We focused this evening on the application for the PPP, the Economic Injury Disaster Loans, the EIDL. So take a look, work with your attorney, your accountant regarding any legal and tax issues, specifically on the tax issues, and then payment of overhead expenses, payroll, leases, mortgages, and related expenses. So those are, I know, some of the key considerations that all of you are grappling with right now during this time. Cindy is going to share with you some of the excellent resources the AOA has.
All right, thank you, Jayme. And while we're going through these resources, if you have not typed in your questions to the Q&A box, please do so now, and we will get to those. And Jayme, if you could just, there we go. So this is the osteopathic.org main page on COVID-19. Hopefully you've all seen it and have been there. And then we also have some on-demand webinars that if you have not taken advantage of them or want to go listen to them again or have one of your staff listen to them, please take a look at them. A lot of them, the first one, the Successfully Practicing, that was done by Dr. Brown, who did a wonderful job on just telling you what it's like. He's been doing it for a long time and how to do it now. And then we've got some coding ones up there by Jill Young and HIPAA by
I'm sorry, Cindy.
James Little. That's okay. By Lee Little and James Tuttle. So, and then the next one, our upcoming webinars. Keeping your practice in shape during the pandemic. It's a little bit about keeping your practice as well as keeping yourself mentally and physically in shape. And then we have how to rebuild your practice now and after COVID-19, things that you can be doing to keep that interaction with your patients when you may not be seeing them, and also being able to draw in some of the other patients. And then managing your online presence. Okay, here we go. The next one. And then the telemedicine platforms. Check out these if you have not done telemedicine. These are ones that the AOA has looked at, and they are willing to work with AOA members and give them some discounts and free access. Okay, next one. And then to obtain the CME credit, you need to go back to the AOA online learning platform, go into the course, and there's a post-evaluation that is available there. It will be available at 8:15 Central Time. So go back in there, take the post-evaluation, and then you can either print out or download the certificate. We will be reporting it to AOA CME department on your behalf, but due to the increase in CME, it may take a little bit longer than usual. Okay, and this is Jayme's contact information should you have questions, or physician for services. And then,
perfect.
we will go to the questions. Is my phone cracking out still, Jayme, or are you able to hear me okay?
I can hear you really well, actually,
Okay.
yes.
Good, good. I just want to make sure. Okay, so first question. As a small private physician practice of 3 physicians, which has already received our SBA loan under PPP via our local bank, of which we have a long-standing banking relationship, can the 3 physician owners, employees, payroll salaries be included as eligible expenses under the 75% employee payroll requirement?
Yes, the answer is yes. You can include those 3 physician owners, employees' salaries. However, remember, with the SBA loan under the 7A, the PPP that you've received, it's capped at $100,000. And so, again, that doesn't include like deferred compensate or deferred defined benefit or deferred payment for insurance and that. So yes, you can include those 3 physician owners, employees, payroll salaries up to, it's capped at $100,000.
Okay. Next question you just answered about it, including the physicians who are owners.
Yes.
So do 1099 employees count?
That's a good question. Independent contractors do not count. Because they're under the PPP. So if you have independent contractors, whether they're other physicians, PAs, whoever the case might be, any other providers in your practice, those 1099 employees, because you're not paying payroll taxes and there's a set amount, those 1099 employees should apply for their own loan. So they do not count towards the PPP enrollment, or excuse me, the PPP payroll.
Okay, and our next question, I mean, they're all falling in line here. The next question was, can independent contractors apply for PPP if the work is 100% telemedicine in prior years and also current? No patients, strictly telemedicine, but due to volume drop and reduced hours, have less income coming in.
Yes, so the answer is that's exactly correct. The independent contractors can apply for their own loan, even if there's 100% telemedicine, that's fine in prior years, because that's still, even though it's been telemedicine, that's still considered provision of services. So telemedicine counts. And then let me see the last part of that. And then it says no outpatient, strictly telemedicine, that's fine, but due to volume drop off and reduced hours have less income coming in. That's fine, because it's, again, not necessarily based on the income coming into the practice as much as it's based on what the overhead expenses, meaning payroll, rent, mortgage, and if you're doing telemedicine, you may not necessarily have a bricks and mortar practice, or you may have like a headquarter or a main office. So it's not based on volume drop off or reduced hours, as long as you were in operation and providing care.
Okay. What if you rented prior and then had a mortgage starting end of March?
Ooh, that's a good question. I like that. Yeah. Sorry, got excited there. If you're rented prior, so that's like the proverbial law school exam. How do you qualify this? So go back and think about that one slide that we had where we looked at the time frames. So if you rented prior and then had a mortgage starting the end of March, how would you do this? So bottom line, you would take your lease, your lease agreement, and you'd qualify that time period before March. So as long as you're in business and practice as of February 15th, 2020, you're eligible for a PPP loan. If you were renting prior to that, you would just allocate that rent payment for whether it was last year up through into March of this year, and then your mortgage starting at the end of March 2020. So you basically, it's just an allocation of rent versus mortgage, and you would just fill that into the application. So important, that's a good question, because I think this happens often, especially with physician practices, if you're transitioning, if you're buying a building, or if you're changing practice locations. So just need to allocate the proper dollar amount.
Okay. And can one obtain a PPP without a business account?
Ooh, that's a good question too. I've been told the answer is yes. The answer is yes to that. As I mentioned earlier in the discussion or the presentation earlier, it's been across the board as far as which lenders are the best and easiest to work with. I don't have a definitive answer for you, but yes, you can get a PPP without a business account. Yes.
Okay. And if one makes more than $100,000 per year, then what is the max that can be paid over 8 weeks to that employee? How does annualized income come into play?
Okay, so if one makes more than 100 per year, what you're just capped. You can only be eligible up to the $100,000. So say, for instance, I'm giving an example. You're making 150. The first $100,000 of that compensation is eligible for the loan and the forgiveness on the payroll, not the 50,000 above. So just your baseline is the $100,000, and then what is the max that can be paid over the 8 weeks to that employee? It's to cover whatever the payroll for that 8 weeks of I'm not doing the math right now, but whatever the percentage and the payment for the 8 weeks, the 2-month period for that $100,000 is, and you annualize that, come out into play. So let me break that down. So whatever the amount based on the $100,000 for that 8-week period, that's what can be paid to the employee. And if you don't reduce that 8-week payment for that $100,000, that amount can be forgiven. Now, if you reduce it, remember under our example where we reduce the salary, if you reduce it, then your loan forgiveness is reduced. So whatever the $100,000 for the 8-week period can be forgiven.
That's a good point. That's where I think a lot of people don't realize that if they reduce the salary.
That's right. That's
Yep.
right. If you cut the employee or you reduce their salary, then that reduces the amount that your loan forgiveness is going to be.
Okay. You did not mention the 75-25% payroll, non-payroll use of PPP loan money. Is it true that one may use up to 75% of funds for payroll expenses and then up to 25% of funds for non-payroll expenses, healthcare benefits, utilities, etc.?
Right. That's a good question, because that's the numbers that have been used in what I've been reading in the media. So in the actual CARES Act, it's not necessarily broken down to the 75-25% on the payroll versus non-payroll. It's broader under the CARES Act. It says that the payroll, mortgage interest, rent, and utilities, those are the main 4 that will be forgiven. So the 75-25% has been what's been used as a guideline. However, that's not specific in the actual regulations. So to your point though, if you're using up to 75%, you're correct. The PPP is designed to weight heavy and provide relief based upon payroll and overhead, meaning rent, mortgage, utilities. So if you're using up to 75% for the payroll expenses, and then you have 25% for non-payroll, that would be a great ratio, because your loan forgiveness would be pretty high then, based on the 75% that you're using. If the non-payroll, the healthcare benefits, the utilities is part of the forgiveness, because it's operational, it's overhead. But if you were using the remaining 25% for healthcare benefits, that wouldn't necessarily be forgiven. So that's been the ratio that's been used and used as a rule of thumb. But however, it's not specific. There's no specific percentage in the PPP.
Okay. My practice pays rent for office space, but currently does not have a lease for this space. Can my rental costs be included for proceeds of the PPP?
That's a really good question too, and I've seen that question play out too. You do want to so ideally to have the lease agreement would be the ideal and is the standard that you're using. However, if you're applying for a loan and you're attesting and authorizing, if you can show that that lease payment is made, if you don't have a formal lease in place, but there's money being paid to the landlord, meaning by a check, by a transfer by either check or transfer of money. What's happened is some of my clients have different entities and they maybe have forgotten or they don't have a formal lease agreement, but they can show that there's rent payments. So you can allocate that and hopefully capture that because that's a true expense of the practice. Ideally, and for purposes of not having to worry about documentation, having the lease is the best case scenario. However, if you can show that there's rent being paid by a check, that should suffice as well.
Okay. Can I count my malpractice insurance expense towards this?
Oh, that's a good question too. Yes, you can count that your malpractice insurance and all of your insurance, like your premise liability insurance. However, that won't necessarily be part of the forgiveness program, but you can count the malpractice, any of your overhead expenses to run your practice, which of course includes your malpractice, can be included, yes.
Okay. I am an employed physician by a group of physicians that applied for the PPP loan. I am directly assigned 6 employee wages to me. Will the group applying for a loan help my overhead monthly cost?
Okay, let's see. Okay, let me figure out. Okay, so you're employed physician by group, okay, that applied for the PPP, and you're directly assigned the 6 employees to directly. Will the group applying for the loan help my overhead monthly cost? I think I need a little more help with that one. I think where the question is going is, I'm not sure if the employed physician, if they're all part of the group practice. I think they are based on the question. I need a little more clarification, but my response would be is that if the group practice applied for the loan and you're directly assigned those 6 wages, meaning you're responsible to cover the wages, you individually as a physician, but you're part of the group practice, the group applying for the loan should be able to use your overhead, meaning your compensation up to $100,000, and then any assigned employees' wages. Because if they're being paid they're not independent contractors, but they're employees of the group practice, all of you, meaning the 6 employees that are assigned to you and yourself and the other people and other physicians in the practice, should all be used to allocate and figure out the payroll applying for the group that's applying. If you're separately applying, then you would have a separate application. I hope that helps.
Who would provide the PPP for someone with no business account set up? I believe we already answered that.
Yeah.
Okay. As an emergency physician working for a large EM physician group whose hours and income have been reduced because of decreased volume due to the pandemic, am I eligible for a PPP loan?
Yes, you are eligible. Even if your hours have been, and then that's what the PPP loan is trying to help physicians and group practices because of the reduction of volume. This 8-week period from February 15th till June. So if you're an emergency physician working for a big practice, if you have to check. First best practice would be check and make sure that your physician group that you're part of, have they applied for a loan? You know, if they've applied for a loan and you're part of that loan, meaning you're part of the allocation, and you're expecting to be compensated under that loan, you have to be careful that you're not applying for a loan that's already been processed and applied. However, if they have not included you, meaning the large EM physician group has not included you, you can be eligible for your own loan. So that goes to your corporate structure and who's applied and who's on the application. But if your hours and income have been reduced because of the decreased volume, because of the pandemic, you may be eligible for the PPP loan individually if you apply individually or if you're part of the group.
Okay. Can a full-time employed physician who also does a local tenants job as an independent contractor qualify for any of these loans?
So yes, if you have your own practice and you're doing locums, and you're independent contracting with other practices and providing services, you should not be included on their PPP loan, but you should have your own loan. So yes, you could qualify individually under your own entity. If you have an entity set up to do the locums, your own corporation or LLC, or as your own, as a physician providing services. So yes, the answer is you can definitely submit your own PPP.
Okay. So for independent contractor with reduced salary, does that mean there is no forgiveness with PPP due to reduced salary for self-employed?
Oh, so that's a good question because that was looked at. We're not sure yet. I would like to give a definitive answer on that, but because this is still playing out, so the answer the answer to that is if you're an independent contractor, 1099, your salary's been reduced. The forgiveness, it's supposed to cover. So if your salary's reduced based on the pandemic, meaning you haven't cut it voluntarily, you haven't given yourself a salary reduction to cut, you haven't cut yourself or you haven't reduced your salary voluntarily, but it's based specifically to the COVID-19 because of the patient volume and the availability of care, the ability to give care, patient care. There could be forgiveness based on this reduction that's directly correlated to COVID-19. As long as it wasn't, as long as you didn't fire yourself, and I'm not trying to be tongue-in-cheek here, but this is like a catch-22 because you're controlling as the independent contractor, your, what you're able to pay yourself and as far as salary and compensation. But there should still be forgiveness as long as you can show that the reduced salary and it's due to self-employment and not because someone was trying to cut you from the practice or reduce your salary. So there should still be loan forgiveness.
Okay. Is the amount of forgiveness 100K divided by 12 or 100K divided by 12 times 2.5?
I believe it's the latter, the 100K divided by 12, the 0.25. That's the formula. So it's the 100. You're capped at $100,000 for 12 months. In the preceding, you annualize it the 12 months, and then that formula is the 2.5.
Okay. Is it possible for 100% of the PPP loan to be forgiven?
I don't think so. It could be possible. I've tried to run that scenario through my mind as far as how, and I've done some research on this, and I can't figure out, because and here's why. I don't think it'll all be 100% forgiven because if you have a mortgage, and if you don't have a mortgage and you're renting, there is the possibility that your percentage will be much higher. But overhead expenses like the 401k, the defined benefit, if you're using the PPP to fund any of that, that won't be forgiven, because that's not part of the payroll. That's considered a health benefit and health insurance. So if you're using any of the loan to pay for your employees' health insurance, mortgage payment, then it wouldn't be 100%. But you could be pretty close. You could probably get pretty close to 100% forgiveness if on the PPP loan, if you're renting your space, meaning for your practice, and the expense for the PPP is payroll heavy and utilities, for operating. But that's a good question. I have not been able to figure out a scenario where it would all be 100% forgiven.
Okay. I am a sole proprietor and have several independent contracts. I have been able to keep up with one of the contracts via telemedicine. Do you subtract the partial income that you have able to earn from the current average monthly payroll loan request?
Okay, so glad to hear. That's good news that you're that you have the independent contracts and that you're able to service one of the contracts via telemedicine. That's good news. So yes, I believe you can subtract the partial income that you're able to earn from the current average month. However, what you want to take a look at as a sole proprietor is if you were full up and running under all of your contracts, even including, of course, telemedicine, what your compensation would be. So you can subtract the partial income that you're able to earn on the current average month from the payroll request. But what I would suggest doing is take your overall, if you were from February 15th through June, you were able to operate with all the contracts that you have, provide the full care service to all, including telemedicine, and use that as what your earning potential would be.
Okay. How can I find a lender for PPP without prior business account?
Ooh, okay, that's a good question. What I would suggest doing is, if you have a relationship with the bank, even if it's with your personal accounts, that would be the best place to start. Whether it's a community bank or a large national bank, if you have a relationship with a lending institution, I would suggest starting there, even if you don't have a prior business account. They can help you. And then I've had some clients that have been successful with other, they've shopped, if you will. They've looked at other lenders within the SBA approved lender list or federally insured. I've had one client that had some success with a credit union of all places. And so I would start with who you have your current relationship with, even if you have personal accounts, and get some recommendations from there. Because what I've seen is this is very community-based, not meaning community bank-based, but where you're at in your community, within the state where you're practicing and within your community. And that bank and lender should be able to point you, hopefully, to somebody, to a lender that will be able to help you. And then the second part, and does it mean opening a business account is required? No, you don't have to necessarily have a business account to obtain a PPP. It definitely helps because they have all of your tax ID numbers, and they have everything tied from your corporate entity. But I would start with your lender and get some recommendations from them, and then take a look at some of the SBA lenders.
Okay, and actually the AOA one of our member value partners actually has a program called Lantern, and it's available on the member value webpage of the AOA under practice tools. And they allow you to shop, look at several lenders at a time to see which one best fits you. So check out the member value page on the AOA's main webpage. Okay.
That's a great, Cindy, that's a great tool and a great resource. Yeah.
Okay, next question. As a sole proprietor, how will the PPP program want you to verify medical leave or sick leave?
Okay, that's a good question as well. If you may or may not have, as a sole proprietor, if you have any policies and procedures, which you may not have. So if you did have anything in writing as far as like a handbook or any operational policies, that of course would verify it. What you're going to have to probably most likely do though, I mean, that's, you know, probably the exception as far as a sole proprietor having a, you know, having that in play. But if you have something like that, that would satisfy the requirement. Basically, to verify this, the lender is not going to independently require verification. You know, they're not going to underwrite this or check this out. So you would be attesting on your attestation that all the information you're giving is accurate. How I would look at that is where you're practicing. What's traditionally and typically used in your catchment, your service area for medical leave or sick leave, or what you're, you know, maybe what you've used at another practice or another group practice. So you have the ability to allocate that, and you will be verifying that on your application. So you want to probably use what I would consider fair market value, if you will, on what would be acceptable for medical and sick leave.
Okay, this I believe you answered, but we'll ask it again. If I make, say, $150,000 a year, knowing that the PPP loan is capped at $100,000 per year, by reducing my monthly salary to $100,000 divided by 12, does this reduce the amount my loan forgiveness?
Okay, that's good. That's a variation on the previous question, to the extent that by reducing your salary, is the loan forgiveness? The answer is not necessarily, because you're capped at $100,000. That $50,000 wouldn't have been, you wouldn't have gotten credit, if you will, under the application under the PPP for that additional $50,000 on top of the 100. So if you reduce your monthly salary to the $100,000 over the course of 12 months, you're still going to have the same amount because you're capped at $100,000.
Okay. And do I qualify as independent contractor if my drop in income is due to kids being home and not in daycare due to my personal concern of pandemic?
Oh, okay. That's a good question as well. Independent contractor is that status is going to be how you file your taxes and have filed your taxes, whether you're a 1099 or a W-2, and it's based on the IRS guidelines for what an independent contractor is deemed to be. So an independent, I'm going to speak broadly, because I'm by no means a tax attorney, but independent contractor in a practice doesn't, an independent contractor 1099 pays their own payroll tax and does not, oftentimes does not get benefits, healthcare. And again, I'm speaking broadly because there's always variations on this. But if you qualify as an independent contractor due to your income because of daycare with children, care at home, and not being able to use daycare, and your personal concerns, of course, for safety during the pandemic, you have to look at whether, if this was your practice and you were an employee, or you were an employee of a physician practice and you were paying taxes up till February 15th, 2020 as a W-2, you would still remain a W-2 for purposes of that practice. If that practice, or if you as an owner or member of that practice apply, you would still be an employee for purposes of how you've paid taxes. So if you, I don't know that you necessarily would qualify. What I'm trying to say is that classification of independent contractor really goes to, while the considerations are, of course, during this time period with daycare and childcare and concerns about being able to practice and provide patient care. However, it's really based on how you pay taxes and payroll taxes.
Okay. In terms of the emergency grant, where can the paperwork be assessed for that option?
Oh, so that's a good question for the disaster loan under the 7B. If you go onto the SBA's website, you will get that application. And so, and you can also, most lenders are, of course, have access to the application, but just go onto the SBA's website and you'll be able to pull that up.
Okay. And is it a loan or a grant?
That's a good question. It's both. Well, let me qualify that. It's really a loan. But remember that if you qualify for the emergency grant, the 7B, that you automatically get the $10,000 within 3 days of applying. And then if you're deemed not to be eligible for the 7B, you still get that $10,000. So one might say that's a grant to the extent that it's forgiven and not paid back. So it's a forgivable loan or a grant, depending on how you define that. But for purposes of the 7B and from the SBA definitions, it's considered a loan. But that $10,000 will be forgiven.
Okay. Also wanted to let everybody know that Joanne typed in the lanterncredit.com. The link is in the chat box, so check out your chat box if you want to learn about Lantern. And then if I've applied for an SBA website, is there time to apply for PPP?
Yes, there is. There is time. And that's a message I want to give tonight too, because I know that this has been a very difficult time for all of us, and there's a lot of media and there's a lot of hype about the PPP. I still think it's worth your time and energy to apply, because I know the second round opened on Monday, and everybody's concerned that the money's already being allocated. That's not true. You know, they're still in play. It's still in play. And so, yes, there's still time to apply for the PPP. And also, I think, I can't guarantee this, and I don't have anything in writing yet, but I think there may be another round of this, just because of the incredible need. And the longer this goes, as many of us are sheltering in place and staying home, working from home, or doing what we need to do to take care of family and be at home, and for safety reasons, I think there's going to be additional money that's allocated.
Okay. And our last comment, I do not have a question, but I want you to know how much I appreciate all the information and help that you have given us. So,
I
ditto that. Excellent information, Jayme, as always. It's a pleasure having you.
I agree. Oh, thank you very much, Cindy. I appreciate being invited, and I wish all of you the best. Please stay safe and healthy. Thank you for your questions, for your attention, and I wish you all the best. And please use the resources that Cindy gave you. There's some great resources by the AOA, and I appreciate your time and attention this evening, and please stay safe and healthy.
All right. Thank you very much, all. This concludes our webinar.
Thank you.